How do real estate developers raise $10 million or more from institutional investors? The access problem is structural, not executional. The high net worth individual network that funded the first 3 deals is built for check sizes of $500,000 to $3 million, not for institutional raises. A better pitch deck does not solve a distribution problem. The only path to institutional capital at $10 million or more is through a credible intermediary with active allocator relationships. How do you get a warm introduction to a family office? A warm introduction is an active vouching from a credible intermediary with an existing relationship on both sides, not a referral or forwarded email. Family offices now provide over 50% of deal-level capital in real estate, up from a historical 20%, according to Alta's February 2026 Family Office Deal Flow Report, and they can operate exclusively on trust networks. Cold outreach converts at less than 1% because institutional allocators, they don't take inbound pitches from operators they have not heard of. What are the 3 structural barriers that prevent developers from accessing institutional capital? The 3 structural barriers are targeting the wrong 87% of family offices, relying on cold outreach that does not work at the institutional level, and failing to meet the higher due diligence bar that followed the collapse of blind pool fund investments. Only 13% of family offices write checks of $10 million or more per deal, according to PwC's 2025 Global Family Office Deals Study. Family office fund investments collapsed from 2,871 transactions in H2 2021, just 186 in H1 2025. Allocators now require a direct GP relationship before committing capital. What do institutional allocators look for in a real estate deal? Institutional allocators evaluate the sponsor before the deal. Track record, team, prior LP relationships, and market reputation are the pre-qualifiers, not projected IRR or equity multiple. The questions allocators now ask are: what happens if the project runs 18 months over schedule? How is the waterfall structured if returns fall below preferred? And have you returned capital to LPs before? According to the JP Morgan 2026 Global Family Office Report, family offices targeting returns above 11% allocate over 40% of their portfolios to alternatives and have nearly double the exposure to direct control investments compared to lower return target offices. How do you access institutional capital without cold outreach? The 4-layer warm introduction framework is the only reliable path. Layer 1 is credentialing. The capital stack, track record, and deal materials must be institutional grade before any introduction is made. Layer 2 is intermediary selection. Advisors with maintained allocator relationships outperform cold referrals by a factor of 10 to 1. Layer 3 is targeted allocator matching on check size, asset class preference, current deployment cycle, and structure preference. And Layer 4 is introduction sequencing. The developer is debriefed on the allocator's specific interests, and the first communication is a targeted deal summary, not a full deck. What does institutional grade credentialing actually require before a warm introduction goes out? Institutional grade credentialing requires 3 things. First, a capital stack with waterfall mechanics, preferred return thresholds, co-investment alignment, and documented GP commitment. Second, a track record presentation showing realized IRR by project, LP distribution, history, timeline adherence, and exit execution, not a project list with completion dates. Third, deal materials including an investment memo, financial model, and risk analysis built to withstand institutional scrutiny. No introduction goes out before the materials are ready. Sending an unprepared deal through a warm channel burns both the allocator relationship and the intermediary's credibility. What 4 steps should a developer take before going to market for a $10 million institutional raise? Step 1, audit your capital stack for institutional readiness, waterfall structure, preferred return, documented code GP investment, and promote mechanics. Step 2, reformat your track record for institutional due diligence. Realized IRR by project, LP distribution history, hold periods, and exit execution. Step 3, test your advisor's actual network by asking them to name the last 3 family offices they placed capital with, the check size, and the asset class. If they cannot answer specifically, they have a database, not a network. Step 4, engage a capital advisor before going to market, not after the raise has stalled. What's the difference between a placement agent and a capital advisor for institutional raises? A capital advisor structures the deal before going to market, ties compensation to capital actually raised, and maintains active relationships with the allocators who request deal referrals directly. Here at IRC Partners, we take 3 to 5% advisory equity, maintain active relationships with over 307,000 institutional allocators, including family offices managing over $17 billion in assets, and covers all future raises through exit under one single engagement. A placement agent merely maintains a contact database, sends your deck to a list, and charges transaction fee on close regardless of structural outcome. The difference is sequence, alignment, and the distinction between an active relationship and a database entry.